stocks have done nothing for 2 years. The NASDAQ is up 70% in the same period. And I want to show you exactly why that gap, which looks like a problem, is actually the setup for one of the most mechanical, most predictable, and most profitable rotations I have seen in the equity market in the past several years. But before I show you what is about to happen, I need to show you something that will completely change how you think about the way money moves between sectors. Because the opportunity I am describing is not driven by a fundamental change in software businesses. It is driven by a mechanical force that operates independent of earnings, independent of management quality, independent of competitive position. And once you understand this force, once you see it clearly, you will never look at a sector sell-off the same way again. Stay with me through the next 20 minutes. Because the 3 specific stocks I am going to show you and the specific entry signals I am watching are only meaningful if you understand the mechanism that will drive them. Without the mechanism, you have a stock tip. With it, you have a repeatable framework that works in every market cycle. Let me start with the gap itself, because there is a specific reason software stocks have underperformed the NASDAQ by approximately 78 percentage points over the past 2 years. And it is not what you think. The narrative that has circulated on institutional trading desks since early 2024 is this: artificial intelligence is going to commoditize software. The argument goes that if AI can generate code, design interfaces, automate workflows, and do it faster and cheaper than any software company's existing product, then the pricing power, the retention, the switching costs that gave software companies their extraordinary margins for decades are under threat. It sounds compelling. It is powerful enough that hedge funds have made $24 billion this year alone, betting that software stocks will continue to decline. But here is the part that most investors are missing entirely. And this is where the real opportunity lives. The question is not whether AI will change software. It will. The question is whether the people who are betting $24 billion against software have already made their money, and whether the trade that has worked for 2 years is now stretched so far in one direction that the reversal becomes the more powerful trade. Think about this mechanically. A rubber band stretched in one direction accumulates tension. The further it stretches, the more pressure builds. And at some point, not always predictable in timing, but reliably predictable in direction, the pressure releases. The snapback is proportional to the stretch. And right now, the software sector is stretched further in one direction than I have observed in several years. I have seen this pattern before, not in software specifically, in oil stocks, 6 months before the Iran conflict started. The money was moving into oil infrastructure, while everyone was still asking whether energy demand would return to pre-pandemic levels. I positioned ahead of that move and generated approximately 60% returns in a period when the S&P was down single digits. The pattern is the same. The sector is different, but I am getting ahead of myself. Let me first explain the specific mechanism that turns a stretched rubber band into a profit opportunity, because this is the part that most commentary on short squeezes gets wrong. When hedge funds bet that a stock or sector will decline, they do so through short selling. They borrow shares they do not own, sell them into the market, and plan to buy them back later at a lower price. If the stock falls, they profit from the difference. If the stock rises, they lose money. And here is the critical detail. There is no limit to how much a short seller can lose if the stock keeps rising. A long investor can only lose their initial investment. A short seller can lose multiples of their initial investment as the price moves against them. This asymmetry creates a specific and powerful dynamic when a heavily shorted sector begins to move upward. The short sellers do not wait for the move to fully develop. They cannot afford to. As the price rises, their losses mount in real time, and their prime brokers begin issuing margin calls, requirements to post additional capital to cover the growing loss on the position. When a short seller cannot or will not post additional margin, they are forced to buy back the shares they sold. That forced buying pushes the price higher. Higher prices trigger more margin calls, more forced buying, higher prices again. The cascade builds on itself. This is what happened to Avis Budget Group in 2021. A stock that was heavily shorted began moving upward, triggered a short squeeze that produced hundreds of % returns in weeks, and then collapsed as the technical dynamic exhausted itself. The fundamental business did not change during that move. What changed was the mechanical pressure of forced buying, compressing months of potential price recovery into days of violent upward movement. The software sector is not Avis. The companies are larger, more liquid, more institutionally owned. The squeeze, if it comes, will not be measured in days. It will be measured in weeks or months. But the mechanism, the accumulated short positioning creating the pressure, the trigger event releasing it, the forced buying amplifying it, is identical. Now here is what I want you to watch specifically, because identifying the trigger is more important than identifying the setup. The setup exists. The positioning data confirms it. But the timing and positioning correctly around timing requires watching specific signals. The first signal is the price action on the software sector ETF. The XSW, the software sector fund, has been trading sideways for months, essentially going nowhere while the broader technology index surged. Every time it has approached the $160 level, selling pressure has pushed it back. This level represents the resistance zone where the short sellers have been able to maintain their position. When that level breaks, when the software ETF closes above 160 on elevated volume, it is the first confirmation that the rubber band is beginning to slip from the hands holding it. The second signal is the short interest data itself. When short sellers begin to close their positions, not because they believe the fundamental thesis has changed, but because the price movement is creating margin pressure, the short interest ratio falls. Falling short interest in a rising price environment is the clearest confirmation that mechanical force buying is occurring rather than fundamental re-rating. It tells you the move has technical momentum that can sustain itself independent of any earnings event or news catalyst. The third signal, and this is the one most retail investors never track, is the options market structure. When institutional investors begin positioning for a squeeze, they do so through call options rather than direct equity purchases, because options provide leveraged exposure to the upside while limiting downside to the premium paid. When you see unusual call option activity, large blocks of short-dated calls on individual software names or the sector ETF, it tells you that someone with significant resources is positioning for a near-term directional move. I'm going to pause here and give you what I promised at the beginning, the 3 specific stocks where I see the most compelling individual setups within the broader software rotation thesis. But I want to be clear about something first. These are not buy and hold positions. They are rotation trades, positions sized to capture a specific mechanical move with specific exit criteria defined before entry and no emotional attachment to the thesis beyond the specific conditions that justified the entry. This distinction matters more than the stock names themselves because the graveyard of retail investor portfolios is filled with people who identified a correct directional thesis, made money on the initial move, held through the reversion because they had married the story, and gave back everything they made and more. Buy and hold works for the S&P 500 because the index is self-cleaning. The losers are removed, the winners accumulate. It does not work for individual stocks because the story changes, and most investors do not have a framework for recognizing when it has changed. The first stock is CoreWeave, ticker CRWV. CoreWeave is not a traditional software company. It is specialized AI cloud infrastructure. Data centers packed with the highest density GPU configurations available, designed specifically for the compute requirements of AI training and inference workloads. The positioning thesis is specific. In a world where every AI company needs more compute than available general-purpose cloud infrastructure can provide, CoreWeave is the premium fuel option. They have long-term contracted revenue from major AI developers, an expanding capacity pipeline, and a direct partnership with Nvidia that gives them priority access to the most in-demand GPU hardware. The stock has been moving upward from its recent lows. The chart shows a structure I look for, a period of sideways consolidation following a sharp decline, with the price now approaching the resistance level of recent highs. The specific level I am watching is approximately $140. A close above that level on volume confirms the breakout. Below that level, the setup exists but has not been activated. The second stock is BigBear.ai, ticker BBAI. I want to be explicit about the risk here because this is a smaller, more speculative name with a higher individual failure probability than CoreWeave. The stock has declined approximately 70% from its all-time highs. It is small, it is volatile, and those characteristics in the context of a short squeeze environment are exactly what make it interesting. BigBear builds AI software for the U.S. military and federal intelligence agencies, specifically systems that process large volumes of complex, multi-source data for logistics, predictive intelligence, and operational decision support. The bull case is institutional rather than consumer. The U.S. government is actively integrating AI into national security operations. Defense AI budgets are growing faster than almost any other defense technology category. And BigBear has documented contract wins and backlog that validate its position in this specific application domain. The stock appears to have established a floor around $3. The pattern of higher lows, each subsequent low slightly above the previous one, suggests that selling pressure is exhausting itself and that accumulation is beginning. The specific resistance levels on the way up will create friction, as investors who bought at higher prices and held through the decline sell to recover their cost basis. That selling pressure is predictable in location and tends to create consolidation periods that ultimately resolve to the upside if the underlying buying pressure is real. The third stock is Unity Software, ticker U. This one carries the most narrative baggage of the three. Unity was one of the most hyped technology stocks of the pandemic era and has since declined approximately 87% from its all-time highs. That severity of decline is precisely why it belongs in this conversation. Unity is the dominant game engine for independent and mid-sized game developers globally. The company builds the tools that millions of developers use to create video games, training simulations, augmented reality experiences, and increasingly digital twin applications for industries including automotive, architecture, and manufacturing. The AI monetization tools they have developed, specifically Unity Vector, which helps game developers optimize in-app revenue generation, represent a genuine adaptation of their core platform to the AI environment rather than a replacement of it. The stock has established what appears to be a double bottom structure around $17 to $18, the same approximate price level that provided support in the previous year. This technical structure, combined with the operational improvements the company has made in cost structure and the early evidence of AI tool adoption, creates a setup where the risk-reward from current levels has improved substantially relative to where it was 12 months ago. Now let me return to the broader mechanism and explain the timing component more precisely, because this is the question I receive most often when presenting rotation theses of this type. Timing in a short squeeze environment is not about predicting when the squeeze will happen. It is about being positioned when the trigger conditions are met. The trigger conditions for the software rotation are the sector ETF breaking its resistance level, short interest data showing initial contraction, and options market activity suggesting institutional positioning. When those three signals align, the mechanical process I described begins. The forced buying starts. The momentum builds. And the duration of the move, typically weeks to months in a sector-wide rotation rather than days in a single stock squeeze, gives positioned investors time to manage their exposure. What the trigger cannot tell you is exactly when it will occur. The rubber band can remain stretched for longer than seems logical. The short sellers who are collectively running the $24 billion position against software did not all enter at the same time and do not all have the same pain threshold. Some will close their positions at a small loss early in the move. Others will hold through significant mark-to-market losses before capitulating. The speed of the squeeze is determined by how quickly the margin calls compound through the system, which depends on leverage levels, broker policies, and the speed of price movement. What history does tell us from every prior squeeze in every sector is that the move, when it comes, tends to be faster and larger than most observers expect. The sectors that have been most neglected are repriced rapidly as new capital flows in simultaneously from multiple sources: short sellers covering, long investors who avoided the sector reversing their underweights, momentum following algorithms detecting the directional shift and accelerating it. Three separate buying forces, all activated within the same price range, all amplifying the same directional move. I want to close with the behavioral dimension because I think it is the most practically important thing I can tell you about this specific type of opportunity. And it connects directly to the distinction between an investor who captures a rotation trade and an investor who identifies one correctly but fails to profit from it. The mistake that costs the most money in rotation trades is not the wrong entry. It is the right entry followed by the wrong hold. A stock that moves from $27 to $45 in 6 weeks will, on the way there, have several $2 to $3 pullbacks that feel in the moment like the move is over. The investors who sell at those pullbacks capture a partial gain. The investors who have defined their exit criteria around the technical breakdown of the move, around specific price levels or specific changes in the short interest data, hold through the pullbacks and capture the full rotation. Software stocks have underperformed the NASDAQ by 78 percentage points over 2 years. The positioning against the sector is at levels not seen in years. The rubber band is stretched. The pressure has been building. And the three specific stocks I have described, CoreWeave, BigBear.ai, and Unity Software, are positioned at the intersection of the sector rotation thesis and their own individual technical setups in ways that create the most favorable entry conditions I can identify within the space. The unthinkable, in this case, is not a market crash. The unthinkable is that the most hated sector in the market over the past 2 years becomes the best performing sector in the market over the next 12 months. It happened to energy in 2022 when it was the most neglected sector in every ESG-constrained portfolio. It happened to financials after 2009 when every investor was convinced that regulation had permanently impaired their earning power. It happens reliably to the sectors that institutional capital has stretched furthest in one direction. The unthinkable is not coming because software is good. It is coming because of $24 billion of short positioning that has to unwind. And when it does, the move will not wait for you to decide you are ready.